Hi, welcome back to another tax tip brought to you by Ferguson Financial Solutions. I'm Joshua Ferguson, and today we start a two-part series where we'll discuss active participation and then material participation. Now, some of you watching may have rentals, and you may be thinking, what is the point of a rental? All it does is cost me money. The tenants destroy the place if I can even find tenants. I have to worry about evictions. Oh my gosh, evictions. I I just want out of my rental. If that's you, I'm here to give you a silver lining to your rental activity. It's called active participation. So, active participation happens when an owner of a rental property is engaged in decisions and activities like finding tenants, deciding on rental terms, collecting rent, approving expenses, performing repairs, or even hiring somebody to do those repairs, mowing the lawn, plowing the driveway. Any of those activities are considered active participation. And the benefit of active participation in a rental activity is the allowance of a loss. Now, why is this important? Generally speaking, rental income is considered passive income, which we'll cover in a separate tax tip. But passive income can only be offset by passive losses, and they're subject to passive activity loss limitation rules. So, if an owner of rental property actively participates in rental activity, that triggers the special allowance, which allows up to $25,000 of rental losses to offset other income, like wages. Now, for an example, let's just say you own two houses. You live in one and you rent out the other. Now, you also have a job. Let's say you earn $75,000 a year. The rental house had a loss of $25,000 for the year, which is the maximum annual deduction under the special allowance rules. Now, you can reduce your wages, your $75,000 a year job. You can reduce that by $25,000 of your rental loss. And in some situations, it will put you into a lower tax bracket, so you pay even less in taxes. That's a pretty good situation in my mind. Now, as with any benefit, there are some drawbacks. In this case, as we discussed, the losses are limited to $25,000 a year. Now, if your income's between $100,000 and $150,000, the losses are what they call phased out. And what that means is it's reduced. That $25,000 a year maximum deduction is reduced. Now, if your income is over $150,000 a year, the deduction is completely eliminated. You also must own 10% or more of the rental property. Now, active participation rules are much less stringent than material participation rules, which we'll discuss in another tax tip. And they can offset your other income by using the special allowance to bypass passive activity loss limitation rules. I hope that helps. Thank you so much for watching. Ferguson Financial Solutions can be reached at 907-395-4027. Pick up the phone, give us a ring, or better yet, visit us on the web at fergusontaxpros.com. If there are tax tips that you would like to know more about, any tax topics, leave them in the comments below. Remember to like, share, and subscribe, and we'll see you next time for another tax tip where we talk about material participation.